Hey everyone, you know that exact feeling, right? You hit a nasty losing streak, get incredibly frustrated, and immediately start hunting for a brand new holy grail indicator. We've all been there. Most traders chase consistency by constantly searching for a new strategy. But what if I told you the real secret to consistent profitability isn't another indicator? It's not a secret setup. Today, we're going to break down exactly why keeping a professional trading journal is the ultimate, true secret to consistency. Let's dive right into it.
It's a painfully familiar cycle, isn't it? You start the week strong, but by Thursday, bam, you take a hit. You get emotional, you oversize your next position trying to make it all back, and suddenly, you are blowing up your account. Then, instead of looking in the mirror, what do? We blame the strategy, the market makers, or maybe just the fact that Mercury is in retrograde. You hop onto YouTube or a Discord server hoping the next magic bullet setup will finally be the one. It's totally typical frustrated trader behavior. Honestly, it's just throwing darts in the dark instead of actually measuring your performance.
So here is the tough love that every trader needs to hear. The real secret? It's just tracking what you already do. Look, consistency doesn't come from changing your systems every single week. And it definitely doesn't come from constantly guessing what went wrong after a really bad day. A proper trading journal shows you your actual patterns. It highlights your distinct mistakes, your real strengths, and those hidden weaknesses you didn't even know you had. It literally shines a blinding light on your current actions, so you can finally stop guessing and start systematically improving.
Let's look at the actual painful realities of this boom and bust cycle. Why do most traders stay so wildly inconsistent? Well, first off, they strategy hop after just one single losing week. Second, they have absolutely no hard data on which setups actually make the money. Third, they fall into revenge trading and emotional tilt. That completely irrational, panic-driven state where all logic just goes right out the window after taking a loss. Fourth, they oversize their risk based on pure emotional impulse. And finally, they clearly remember their massive wins, but conveniently forget their expensive, repeated behavioral mistakes. Without tracking all this, every single trading week just feels like a brand new, totally unsolvable mystery.
To fix this, we've got to completely pivot away from just looking at your P&L as the ultimate metric. Think about it. P&L tells you the result, but it tells you absolutely nothing about the quality of your decision. Enter the professional's metric, the R multiple. Now, this is simply the ratio of your actual trade outcome divided by your initial risk based on your stop loss. So, for example, if you risk $100 on a trade and you make 200, that is a 2R trade. It is the absolute best professional way to objectively measure risk management and performance across your entire portfolio, completely regardless of how big or small your position size actually is.
Now, grasping this concept brings about a massive paradigm shift in how you view losing trades. A winning trade can actually be a terrible trade if you broke all your rules and just got lucky, right? Conversely, a losing trade can still be a genuinely good trade. Hear me out. If you risked $100, the trade went against you, and you exited exactly at your stop loss for a negative 1R, that is a good trade. You followed your plan, you respected your stop loss, and you managed your risk perfectly. But if you ignored your stop, held on out of hope, and took a negative 6R loss, that means you broke your rules and just let your account bleed. True consistency comes from judging your process, not just the financial outcome.
The really crucial point here is that you need enough data to actually judge that process. You literally cannot evaluate a strategy after just 1 week. If you take 10 trades spread across 3 completely different strategies, that tells you absolutely nothing. You need 30 to 50 trades on a single strategy to actually know if it works in the long run. This hard data completely debunks that amateur habit of strategy hopping we talked about. You have to execute consistently enough to let your statistical edge actually play out over time.
Okay, so how do we actually implement this? We build what we call the professional journaling loop. You really have to treat trading like a business with a strict 4-step feedback loop. Step 1, log. Record the right data, your entry, exit, setup, and risk amount. Step 2 is absolutely crucial. Reflect. Write down your mindset, your emotions, and whether you actually followed your plan. Step 3, analyze. Review those R multiples and look for patterns across similar trades. And finally, step 4, refine. Update your trading rules to correct those specific behavioral leaks you just uncovered.
When you repeat this loop over and over, it completely lifts the fog. A proper journal reveals exactly where you're bleeding capital. It shows you your absolute best and worst performing setups. It tells you your most profitable time of day, like maybe you trade flawlessly in the morning, but completely give it all back in the afternoon. It highlights your biggest emotional triggers, like FOMO or tilt,
And most importantly, it tells you whether your losses are coming from a flawed strategy or simply from your own poor execution of what is actually a winning strategy.
To get these deep insights, though, you have to undergo a major mindset shift. Stop treating journaling like it's tedious high school homework. It is your ultimate performance tool. If you're just plugging your entry and exit into a spreadsheet and calling it a day, you are completely missing the point. The traders who consistently grow their accounts don't just log flat numbers, they measure, they review, and they adjust based on qualitative, emotional feedback.
Now, I know the friction of manual journaling is exactly why most people quit within a few weeks. It's a drag. That is exactly where TradeZella steps in as the ultimate accelerator. Instead of spending hours on data entry, it automates the tedious parts. You get automated syncs with over 500 brokers, a tick-by-tick trade replay system, a super robust backtesting engine, Zella AI for automated pattern recognition, and even prop firm sync for tracking your funded accounts, all in one clean dashboard. It provides the complete professional infrastructure that most retail traders usually lack.
Let's contrast the old way versus the new way. Manual spreadsheets, they require incredibly slow data entry. They just give you flat numbers without context, and they're heavily skewed by hindsight bias because, let's face it, looking at a static chart makes every single exit look obvious after the fact. TradeZella, on the other hand, gives you automated imports, visual trade replay that actually recreates the market conditions, and AI-driven behavioral insights that tell you exactly what you're doing wrong before you even realize it yourself.
Visually tracking your habits completely changes the game. Seeing your daily streak, visualizing your consistency, and logging your subjective notes builds unshakable discipline. When you can literally see your trading days mapped out in front of you and you note exactly whether you followed your rules or broke them, you start treating your trading process with the respect it actually deserves. It creates a level of accountability that you simply cannot get from keeping it all in your head.
Now, this next concept is an absolute game changer. Trade replay is literally like watching the game tape if you were a professional athlete. In the heat of the moment, trading moves fast, really fast. You rush decisions, your heart rate spikes, and you miss critical context. Trade replay uses real tick-by-tick data from your journal to let you watch the trade unfold, candle by candle, exactly as it happened. You simply cannot fix an emotional panic exit if you can't rewatch the reality of the chart exactly as you saw it live.
And the financial cost of skipping these reviews? It's absolutely massive. Unreviewed trades can quietly cost 5 to 10% of your account value every single quarter. Think about that. If you skip reviewing your trades for even 2 weeks, you might repeat a very fixable mistake, like oversizing right after a loss, multiple times, causing thousands of dollars in totally avoidable damage. That's exactly why Zella AI is built in. It acts like an analytical trading partner that never gets tired, catching those super expensive patterns you might overlook. As we wrap up, I want you to really absorb this thought. When you focus entirely on the process, profits become the natural output of consistent execution over time. Losses become exactly what they should be, simple data points and learning opportunities, not emotional catastrophes that demand immediate revenge trading. You build a system, you measure it meticulously, and you let your edge play out.
So it is time to stop guessing and start measuring the truth about your trading. The traders who truly grow are the ones who review and adjust. Build your professional feedback loop today and check out TradeZella through my exclusive link below to get 20% off. But hey, before you take your very next trade, I want you to ask yourself a serious question. Are you going to keep throwing darts in the dark, hoping to get lucky, or are you finally going to start measuring? The choice is entirely yours. I'll see you in the next one.